Welcome to Go-to-Market Science, the podcast for CROs and revenue leaders scaling mature B2B companies. There's an art and there's a science to go-to-market, and we're obsessed with the science. In this podcast, we share tangible, actionable playbooks from the trenches, from what we're learning working as go-to-market strategy and RevOps consultants for our clients here at Union Square Consulting, and candid conversations with revenue leaders in the market that have been there. If this podcast delivers value, we'd love a 5-star rating and a follow. Now let's get into it. Welcome to another episode of Go-to-Market Science. Today we're going to talk about investing in customer success and how to quantify the ROI. ROI, if I can pronounce that correctly. Today, my special guest is Ben Murray, the SaaS CFO. Thanks for joining us today, Ben.
Eddie, it's great to be here. Looking forward to the conversation.
I'm excited to dive into this. So here's the elevator pitch for our listeners out there. We all know that taking care of our customers is the easiest and cheapest way to generate future revenue. However, we also know that customer success is often underfunded and understaffed. I wanted to know why, and I wanted to know how to fix it. So I invited Ben onto the show to explain this today from the perspective of a CFO. So again, thank you for joining us. I'm so excited to dive in with you.
Yeah, me too. Yeah, looking for the conversation. I know probably a lot of topics we want to kick off with, but yeah, let's dive in.
So I want to start with like the bigger issue. Why is CS sometimes or often understaffed and underfunded? The hypothesis I have is because it's harder to understand the ROI in investments in customer success. Why is that? Why is ROI and CS harder to calculate than new business?
Yeah, it's really interesting. I know we kind of had a conversation weeks ago about this, and I know you don't see much about it. We know customer success is now a function within software companies, and I found from my CFO lens, it is difficult. And even for me, when I take my CFO perspective on this and try to put the math to it, it's like, boy, that was a hard exercise. And I think personally, it's so difficult because it's something where the numbers are always moving. We think about a software company, subscription company, AI company, and we have our recurring revenue. We have our beginning balance of MRR. We have new MRR coming in. We have expansion, we have contraction, maybe we have reactivation, churn, and then that's our ending balance. And all those layers, those what I call layers of MRR, are moving each month. So we're calculating retention at a point in time, but then we have to figure out, all right, if we have a customer success initiative, what are their goals? Is it a gross revenue retention number where we're looking at minimizing the churn and contraction layers? But then what if expansion happens and that improves our number? So that's why it's like the numbers are constantly moving and you have to make some assumptions around retention patterns and go forward numbers to kind of squeeze out a difference to figure out, all right, if I improve retention or explicitly gross revenue retention, say by 1 point, what would that do to my total revenue over the next 12 months to figure out if that change would, say, offset the investments that we make in customer success or any retention programs.
Yeah, it made sense to me, especially after I read your article, and we'll put the article in the show notes. It's a great article. I think you wrote it more for finance folks. As I was reading through it, I'm like, wow, this gets really deep into the weeds. I wonder if like our CROs and CMOs that are listening to this and heads of customer success are going to want to follow like how you calculate bookings and forecast this out and everything like that. But I think it's really important for people in go-to-market to at least understand high level how CFOs are looking at these decisions, because ultimately, if you're in a position where you're saying, look, I think if we did X, Y, Z, we could retain more of our customers, you've got to have a conversation with your CFO to say, I need budget to do A, B, or C, and I think it's going to move the needle improving our retention. Well, cool. How much? And is this really where we should be investing our money? And I think the challenge is when we compare this to new business that gets all the love, all the budget, et cetera, the reason for that is it's so much easier to understand, especially sales. I mean, look, if I'm a full cycle AE and I just bang the phone and make cold calls and I close $1 million of business and you pay me $200,000 or $300,000 or whatever it is for that, and then you tack on my overhead, it's really simple and easy to calculate the ROI of that investment. Then we loop in marketing, and now we've got this crazy attribution that's really difficult, but we can still just say, okay, this is how much we spent on sales and marketing in total, and this is how much new business we landed, and we could do some very simple math to figure out whether or not that math is mathing. But on the retention side, it's way more complicated. And so I want to break down exactly what you just said and try to simplify it so our listeners can really like take this home and think about what we do with this. And so I'll start by doing some very basic accounting, and I'm going to hold you back like by a long shot, Ben, so you don't get too complicated for our go-to-market folks. Let's do like accounting 101. Where does customer success sit? In your article, you talked about two places on the P&L or the net income statement that this could go. Where would customer success sit on the income statement?
Yeah, and it's a great first thing. We have to set some of the foundation here, because one of my top coaching session with SaaS companies is the proper software P&L setup, whether you call yourself software, SaaS, AI, I don't really care. It's about the revenue streams that you offer. You have subscription usage, et cetera. But we think about SaaS, COGS versus OpEx. And traditionally in COGS, we have tech support, we have services for onboarding, and we have customer success. We'll put an asterisk there for now. We have DevOps, so like all the hosting costs, inference costs. We may have hardware costs, et cetera. But then customer success. And I teach this in my academy, but first, whenever I talk to a software founder or company, it's like, okay, you may call them customer success, but what exactly are they doing? That's first, because sometimes you see they're actually onboarding customers. They're doing actually a PS function. Then they maybe do a little customer success too. So first, what are they doing? Is it purely focused on product adoption, where I'd say, okay, let's leave them in COGS, where they don't have a quota or commission. Now, if they're more like an account management function where, yeah, we help with the product adoption, but if customer says, hey, I want that new module, okay, well, let me draft up the contract, customer sign this, and I get commission out of that, then I see that more as an account management or expansion function where they'll be down in sales. Now, sometimes you have very distinct teams and it's really clear. Other times you have mixed CS functions where they do a little bit of both, and then maybe we need to allocate those expenses. So it depends. Are they pure play CS, where I'd say they're up in COGS, or are they actually just traditional account managers?
Yeah, and I want to dive into this because this is sort of a non-financial issue, but I think it's a really important one of what does CS do? Now, I've been on every side of the spectrum here. I've worked in a startup where I was the first account executive covering new business only, and we had 3 people in customer success, quote unquote. What did those 3 people do? This was a product that sat on top of Salesforce. Primarily what they did was they implemented Salesforce for our customers. Secondarily, they handled customer support, tech issues, et cetera. And then thirdly, they did what you would think of as traditional customer success of like helping customers to be successful, which is like very overlapping with doing the implementation properly. And then fourth, I'm not sure how much this was happening, they would potentially upsell the customer. On the complete extreme opposite end of the spectrum, I was at Salesforce while they grew from $5 billion to $10 billion in revenue. And I was an account executive covering new business and existing business, carrying a quota, carrying a bag, trying to close deals, calling into existing accounts, trying to grow those accounts. In addition to that, we had customer support, in the Philippines. We had external implementation partners to implement Salesforce, because for the most part, Salesforce didn't do that, especially with my customers. We had, to a limited extent, CSMs that were responsible for trying to get accounts healthy. And we even had dedicated renewals managers, right? So when the company is big enough, you have all of these distinct roles. And I think each of those roles, in my experience, was incredibly valuable. But I would also argue, and I'm curious if you have a different perspective on this, or you've seen something different, either work or not work, I would make a strong case for moving to a place where you have someone in CS that is solely thinking about making the customer happy and successful, and someone else that is not that same person thinking about maximizing revenue from that customer. And the reason for this, especially when we talk about expansion sales, is that I think it requires a sales skill set to create and close expansion sales. Now, I've got people on my team that would prove otherwise. They'll say we're not salespeople, and they keep landing all these expansion deals with our clients. I think they're maybe the exception to the rule. Very senior people that say they're not salespeople, but they're pretty good at sales. But I think like by and large, for most companies, you want that person that's carrying a bag and a quota selling to focus on selling and to not burn valuable selling time trying to help customers out with things that aren't sales. And then you want the person, even more importantly, that's actually trying to help the customer be successful, to be solely focused on that. Because the second that you start trying to sell to somebody, you lose trust. The second that I come in, and I experience this with our customers, a lot of times I call our customers and I'm trying to figure out ways we can expand them, and they can smell it from a mile away. And I can tell they're like, I just want to talk to Jerry on your team because he's just trying to help me out and make us successful, and he's not trying to upsell us, even as the CEO in the company. And it's just like, I can just tell that, like, that flavor, that different feeling that people have the second that you like put your hat on and think like, how do I grow revenue with this customer?
Yeah, I totally agree, because I think as a CFO and me talking to sales reps, say, yeah, it's like, what angle is here? Are they just really checking in, or do they want to sell me more product? Which I understand. I want my sales reps to sell more product too. But yeah, I was CFO of one company where we created the customer success function internally because, yeah, our account managers existing, going after expansion were also, you could say, de facto CS reps. So if someone wasn't happy or they're checking on things, they were calling their account manager. And like you said, that takes away from them selling. So we want them focused on selling, hitting their quota. So in that case, it's like, all right, it's time for this company to create a CS function. It was coded up to COGS. In this case, it reported to the professional services manager, just in this case, or in support. But yeah, totally agree with that. Yeah, either if you're starting your CS journey or just thinking about all the, like you mentioned before, all those roles within the company, are they AMs? Is it new business? Is it CS? Is it onboarding? And just, from a CFO perspective, like, yeah, we've got to make sure all those seats are hitting the right spots in our P&L so we can have accurate financial analysis.
Yeah, and I would add to that, like, I think the real power here, like when I was at Salesforce and I would call into our existing accounts, the first thing I would try to do is just bifurcate them. What are the accounts that are unhealthy and are going to need attention from CS? And what are the accounts that are healthy that I can upsell? When I was focusing on the unhealthy accounts, I'm looking at this and I'm like, we've got a customer that's not using Salesforce properly, and it is going to take a lot of effort to fix that. What can I do as a sales rep with sales skills and a quota to drive that forward? And I'm like, there's not much, but there's one thing. Like, I'm in sales, I'm good about kicking in the door. So what I'm going to do is I'm going to call the CEO, the CFO, CXO, whatever. I'm going to kick the door and I'm going to say, I don't think you guys are getting as much value as you should. Can I set you up with a call with our CSM, with our implementation partner, with somebody that can hold your hand for the next 6 months and turn you into a healthy account? If I had to do that myself, I probably would never make that phone call in the first place. And if I did, I'd never sell anything.
Yeah. Well, yeah, because that's the whole case in point for customer success and splitting out those teams. And I always refer, and I've probably shortened this definition so much, like Jason Lumpkin had a definition on customer success. A lot of people do, and just kind of focus on product adoption. A lot of definitions out there, but of course they can look for opportunities. That's part of the ROI discussion here, right? We want to improve retention, but also as CS is talking to the customer, maybe there is some pipeline there sitting there that then they can refer that over to the AM. So I've been in places where CS is tracking also pipeline creation as part of their ROI.
Yeah. And it's like, if I could go back to that startup, I was the only AE, and we had like a CS team of like 3. I would just say to the CEO, like, let me sell into our existing accounts. Let the 3 people in CS focus on making customers happy and successful. Let me figure out which of those accounts are super healthy and which I can upsell. And let me go in and try to upsell them, and let these CSMs continue to hold trust with the customer that they're not calling them to try to upsell them. They're trying to call them to help out. And this, I think, sets a really good baseline for like bringing this conversation back to financials and ROI, because what you're saying in your article and what you just said here is, if I'm an account manager carrying a quota, then that goes into cost of sales. Mm-hmm. And then we can just look at that and see, okay, well, how much do we spend on expansion sales, and how much did we actually get back in expansion, closed won bookings? And then we can use CAC payback, CAC ratio, whatever like metrics we want to use that are common knowledge and pretty easy to calculate to figure out whether or not that's working and that's an ROI on our investment. On the other side, the people that are truly doing CS work, that's going into cost of goods sold. And I want to break that down with you. You talked about DevOps and you talked about customer service and a lot of other things. I'm actually curious, just from a CFO's perspective, how do you determine all cost of goods sold before we break down actual like CS? whether that's too much or not enough. Because if I think about this, let's look at this through a private equity lens, right? Let's say that I start my own private equity firm and I go in and I buy this $100 million software company, right? And I'm just going to poo-poo all over PE firms, and anybody that's listening from PE, please don't take this too seriously. And my sole goal in life is just to extract as much cash as possible out of this business. So I want to cut all costs. I'm going to fire the whole CS team. I'm going to fire the DevOps team. We're going to go, I don't know how you support products or SaaS products. Like, I'm not the technical guy, but whatever it is, we're going to go to like the cheapest server we can get, the cheapest tech stack we can get. We're just going to cut costs ruthlessly, right? From the CFO's perspective, why would you push back on me and tell me not to do that?
Well, there are a couple things here because, of course, I love my PE friends, but I think of it this way. If we think about COGS for SaaS companies and AI companies, we've got tech support or customer support. We've got onboarding, professional services. We have customer success. If we have hard expenses associated with usage revenue, we've got to bucket those there too. And we've got DevOps, which could be, AI compute, inference costs, AWS servers, etc. And traditionally for SaaS companies, we shoot for 70 to 80% overall gross profit. So that only leaves me as a CFO of 20 to 30% of expense as a percent of revenue to allocate towards all of those departments, which CS fits into. So, right, if we look at, like you said, hey, we just bought a $100 million AR company, we're PE, we're looking at the financials, we're to look at least my opinion, macro levers that are out of place here. Are they running, say, 65%? Which it's okay. That's
65% gross margin.
Yeah, gross margin. Now, of course, if they're going from 100 million to 200 billion, that's a different story, right? Again, it's all perspective here. I'll give up gross profit because we're doubling at that size. That's amazing. But let's just say, hey, normal growth pattern. All right, that seems out of whack. I'll look up my OpEx profile and how much we're investing in sales, marketing, G&A as a percent of revenue, and calculate all our go-to-market efficiency metrics and look for levers that can be improved. But yeah, if we're running 65% gross margin and we have customer success, well, what's out of whack here? Have we overinvested in any of these departments that hit COGS? And customer success is an easy one to call out. Like DevOps, it's like, all right, that seems all right. Tech support, so all that has to fit within that margin. And if it's not producing, it's like, all right, well, CS, all right, is it actually returning? Are we improving retention? Do we have proof of that? And unfortunately, it could be an easy one to cut if we can't prove out ROI, because we know all these other departments, all right, we know we need hosting. We want to make sure it's aligned. We know, all right, our type of product, we need customer support, right? We need it. We can't just get rid of customer support. And that's why we have to really, I think, as CFOs and CS leaders, really understand what's happening within CS and ROI to say, like, yeah, we need this. We can't just cut it. So that's my kind of CFO lens or even P lens of like, all right, what can we improve to get to that next milestone? And, that's why CS is bucketed within those and is going to get scrutinized if things are out of whack.
Yeah. And I mean, it was such a great and in-depth answer. I think I was, in a way, and I may have phrased it wrong, trying to just throw a layup here, in that like the simple answer is, well, we don't want to do that because then like all of our customers would churn and we would lose money and you would have less cash to line your pockets, Mr. PE guy. But what I thought was really interesting about your answer is, tell me if I got this right. What you're saying is you're kind of using a rule of thumb to say we really mostly want to stay between 70 and 80% gross margin, meaning that the cost of goods sold, all the things you list off, are 20 to 30% of what we're charging our customers. And the reason for that is because if we cut that too much, if we go below 20%, then maybe we're not providing our customers the experience that they're going to need to stick around. And if we're paying more than 30%, we're just running a really inefficient, unprofitable company.
Yeah. So like you said, I think sales. So right, we've got CAC payback, cost of AR, LTV to CAC, all these things to prove out the dollar that goes into our go-to-market engine, how much we get out. And that's why CS is so much harder, that if we're not running these calculations to show over time that we've improved retention, we're creating pipeline, then if say you're bought out by, I won't play PE, but if you're bought out, or anyone, strategic acquirer, right, they're going to assess this. And it's like, yeah, can we get a couple, if we unlock 5 points of gross profit, that's a huge cash flow unlock, a huge cash flow lever, and we have to be prepared to have those conversations to say why, say CS should stay.
Yeah. Especially if you're, doing 6, 8, 10x EBITDA multiple, like that $5 million suddenly becomes 40 million, $50 million. It's a lot of money. I mean, that's exactly what PE firms are trying to achieve. Um, So that's a great answer. It's also just kind of interesting to me. You say like, oh, we can't just cut, customer support. And I'm like, oh, let's look at Salesforce. Granted, I know Salesforce hasn't necessarily been performing well lately. It's just so easy to like poo-poo all over them right now. But it's like even when I worked there, which was a long time ago at this point, like we always felt like the customer service was just terrible. And then now like they're like, yeah, we like fired like half of our customer service agents and just implemented AI. And I'm wondering, how good is that service? Because we still deal with Salesforce a lot. It's like, it's not exactly like grade A customer service, but maybe they can get away with that. They have a sticky product. But I think like, their CFO is obviously looking at these things every day and trying to understand like, do we pay more or less for customer service, for customer success, for all these other things that are going to determine our retention rate.
Yeah,
This leads me into my, oh, sorry, go ahead.
I was going to say that's a great point. Because customer success definitely a function that you're seeing a lot of AI infiltration. And that's why I think it's so hard. It's like the magic number, which is, quarter over quarter revenue growth times 4 annualized divided by previous quarter sales marketing spend. People use that as a go-to-market efficiency number, but it's hard. It's more than that because you're looking at revenue. You've got churn in there. So who is impacting, say, churn? Like you said, well, what if we have a horrible customer support function and someone's like, forget it. I can't get my answers. I'm done with this application. I'm going to find their competitor. It's hard to prove those linkages. And so, yeah, that's where, maybe half the support is AI now. But measuring that, are we losing customers for that? That's harder. That's where it's like kind of the getting back to CS, can we prove out the ROI? Versus just anecdotally, it reminds me of Office Space, or the guy who was it? He's like, hey, I'm good with customers. I talk to customers, trying to, validate his job function, and that's why it's if we can have some hard math behind it, it helps.
Yeah. I mean, and I want to get into like this hard math because it's actually a lot simpler than I thought it was going to be. I mean, I reached out to you because I genuinely wanted to know the answer to this question. And now that I know it, I'm excited to share it with the audience. But before we get into that, I think you bring up a really good point. You talk about the magic number. I tend not to think about that too much. Maybe I should, but I really like just the go-to-market efficiency ratio, or I would really love to just think about things in terms of margins. The go-to-market, we have something we call the go-to-market efficiency margin, where we just take the ratio and just multiply it by gross margin percentage so that I can see like how much did our entire gross margin grow from last year to this year, and how much did we spend on sales, marketing, and CS in order to drive that number. That to me is like a very high level barometer alongside like the rule of 40, for example. And then now we can see like, how is the business performing overall? You could throw a magic number in there if you want. A couple different ways to look at how is the business performing at the highest level. Then we break it down in new business versus net revenue retention. And for new business, it's really straightforward. You've got CAC payback, you've got LTV to CAC, you've got a few metrics that give you the idea of like, how much are we spending and how much are we getting back in terms of new business. When we go into CS, this is where it gets really murky. And I wanted to paint that picture because I'm excited to dive into this formula with you. But the way that I'm looking at this is like, I want to know like overall, is my business performing? Okay, great. Is new business doing well? Is NRR doing well? And keep drilling down until I get down to like the minutia of, oh, wow, like we really have a problem with like our enterprise inbound. And if we do X, Y, Z, either from a financial perspective or an operational perspective, we can make a more valuable, profitable company. But if you can't even figure out like, how do we evaluate customer success? We're still at like the second highest layer. We can't get down further. That was a bit of a ramble. I'll give you an opportunity to react to that if you have any thoughts before I go into my next question.
Yeah, that's why if we think, and I think that's why CS, really needs to understand how gross revenue, and maybe everyone does, but I teach this in my academy, how you calculate gross revenue retention, how you calculate customer retention, how you calculate net revenue retention correctly, what layers to use, because you think about the MRR waterfall, which is beginning MRR, new MRR, expansion, contraction, churn. And why this is so difficult, because you think, all right, if my CS team is focused on gross revenue retention, that's our North Star metric. And this is where are we looking at aggregate retention? Do we have cohorted retention just for me, a CS, assigned certain customer accounts? But say our account management team is doing a great job of expanding our customers, but our contraction and churn profile has not changed. So basically, they're adding more expansion to MRR, which is increasing our total MRR number. So, this is where it gets into the math of like, all right, the denominator gets bigger and bigger, which then ultimately helps our gross revenue retention number, because those numbers are getting smaller in relation to our total MRR number.
Because that's why had $10 million of churn, but 10 million over 150 million instead of 10 million over 100 million is better.
Yeah, that's why this is so hard, because you really have to isolate these scenarios or cohort, because you have so much impact in your MRR waterfall that that the number is constantly moving each month. And that's why my blog post explains that. My blog post, you have an Excel calculator, you can download it and just run through some of this math. And I do think it's a very hard numbers look at it, but it also gets to the heart of, you could say, ROI, where it's like, all right, if retention improves so much, is that covering my costs? But also it gets harder here too, Eddie, because you think, all right, I'm not just saving, like if I save some customer accounts, improve retention, increased MRR, it's not this year that I improved MRR. Like it's that lifetime value too. Like that MRR stays for maybe another couple years, which also, gets into ROI, and this gets into now present value of cash flows and all that stuff. But that's why I think you don't see a lot of this math published out there.
Quick pause. If you're getting value from this episode, I want to ask you a small favor. Take 30 seconds right now, open up the app you're listening to this on, and give us a 5-star rating. It sounds small, but it's the single biggest thing you can do to help us get conversations like this in front of more revenue leaders. While you're there, hit follow so you never miss an episode. Okay, let's get back into it. Let's break this down, because I want to simplify this, right? And I think that the way you did this in your article, after you went through a lot of really complicated accounting stuff, it was relatively simple. So let me explain it, and you can react to let me know if I got it right. So what you're doing is you're saying, okay, like if we change nothing, let's forecast what our gross retention will be. So let's say we're at $100 million in revenue. We're going to churn 20% of that. So we expect to retain $80 million in revenue next year if we just do everything status quo. Then you say, okay, we're going to do X, Y, Z in CS to improve that. Maybe we're going to hire a few CSMs. We're going to ask them to do QBRs, monitor health, do X, Y, Z to try to help these customers be healthier so we can improve our retention rate. All right, how much is that going to cost us? We're going to get 3 CSMs plus X, Y, Z. I don't know, $500,000 hard cost in a year. All right. Now we look and we say, well, I think that if we do this, instead of churning 20 million, we could churn 15 million. So that's an incremental $5 million of additional revenue, in addition to the new business revenue and the expansion revenue. And also in addition to we now have that $5 million of additional revenue that we could potentially retain next year and the year after and the year after that. Now, I'm comparing a $500,000 spend to a $5 million return on my spend. That's a pretty strong ROI. Is that the right, did I summarize the way you're looking at this?
Yeah, that's the gist of it, right? Yeah, exactly. If we're 100 million ARR, we're going to lose 20 million. Let's just say, we're retaining 80% of that. If we, can we improve that by a point, 2 points, 5 points, $5 million? And yeah, that's that hard ROI. That's the math of all right, we need to invest 500,000 to save 5 million, incremental, right? These were incremental changes. Then yeah, we would take that all day long, because we save that 5 million this year, and then maybe we save that for another couple of years.
Now let's role play for a bit. Let's say I'm running go-to-market ops, one or the other, both. and you're the CFO and I come to you and I make this case, how do you evaluate that? There's a lot of assumptions baked in, right? I see two challenges with this. Challenge number one is I'm making the assumption that if you give me this $500,000, I'm going to be able to give you $5 million back over the next 12 months. That's a big assumption. The other assumption is that this $500,000 spend is actually going to impact that we're not going to get that $5 million because the product team over here made the product better. Or, DevOps made I don't know, the product faster and more reliable and less downtime, or so many different variables, or the economy changes for better or worse. How do you look at that as a CFO?
Yeah, that's where it gets much harder, because we have the investment, we have the retention improvement, but like you said, can it be attributed to CS? And I think just like we had a discussion, hey, I won that deal as a new business rep, but maybe they were just, feeling good that day or whatever. Who knows? Maybe it wasn't me. But you're right. Maybe our product team is doing a great job with the roadmap and fixing things that improve our retention, the whole philosophy of product roadmaps. So it is, then, there are a lot of influences there that we would never be able to quantify. But I think in this case, we have to, it's like, I think back to business school, it's like sometimes the professor didn't give me perfect data to work with. It's like, what? Hey, I'm missing data. What's going on here? I can't do this. And that's real world, business cases where it's like, you don't have perfect data and you have to make some assumptions there. So I think it's also just making, if we're presenting these cases, other considerations that people should think about, when we run these analyses.
Yeah. And I think what I'm hearing is we've got to make a lot of assumptions. And at the end of the day, as CFO, you're going to make your best judgment call and you're going to say, okay, you're pitching this $500,000 cost for a $5 million payback. To what extent do I believe that? And how much do I think I can back that? And also, do I have the $500,000 to spend? If you've got the PE firm breathing down your neck to maintain 30% EBITDA margins, you might just not have that $500K, full stop, period, right?
Right. Yeah. And that's where, even if it was all right, invest income of $500K. And if you can, and I see retention improve by $500K in the first year, I would break even, but we know, all right, that will compound over time. So I think it's, putting those numbers on the table, making sure the analysis is clear, and then be able to track it. Then this gets just good metrics, good tracking, good data, because this is a point in time. We're saying, all right, here's how we perform today. Here's how we think we're going to be performing, and we've got to measure that difference.
Are you trying to just give me a layup to pitch the raison d'etre for my belief system around go-to-market? Because of course, in accounting, you're going to want to have good data. And in your article, you lay out this is exactly how to think about bookings and a lot of stuff that's over my head. Thank God I don't work in finance anymore and have to worry about all that stuff. But on the go-to-market side, it's well, how do we measure this stuff? If we don't have a baseline for understanding, okay, we're going to have all these CSMs do all these QBRs, but we don't even measure that whether or not they did a QBR. There's so many things in go-to-market that unfortunately have to be manually inputted, or we have to sync calendars or do something to get that data. I may be maybe grass is greener. I always just assume, Ben, that on your side of the table, you guys have perfect data because it's accounting. But it is very frustrating on the go-to-market side. It's hard to form these hypotheses and test these hypotheses if you're just looking at absolute junk data on the go-to-market side.
Yeah. I mean, your financial data hopefully is locked in pretty good, depending on your stage. But, other things, attribution, right, tricky, all these revenue retention schedules and MR schedules and different segmentation. And, that gets, and that's a big discussion today with AI, right? AI will only do its job with that data if we have good structure, even in history of data, which is a whole nother discussion. But, I mean, we also, financial data, hopefully pretty good, but now it's getting to metadata. All right, I did some debits and credits, but we have to enrich that accounting data. Otherwise, we can't do much with it. If it just says we spent $5,000 on this, well, okay, that was a marketing spend, but what was it for? Okay, it was, social ads. Okay, which platform? Which campaign was it tied to? So all this enrichment, and that's where controllers are getting, I think, much more sophisticated now, is we've got to start, just like we always thought, go to market enriching data, enriching contact data. The same thing on the finance side is enriching all that data we work with now.
You bring up a great point. Like it's like I look at this, and I think it's funny because my wife does. Well, she doesn't do it anymore, but she's been doing our accounting for a number of years. And we've hired somebody else to do it. But it's just like when we're trying to build the process. Like I was just so anal about all these little things. Like for example, client travel. Are we traveling to the client because like we want to do it on our own dime? We want to try to upsell them or improve a relationship or whatever? Or are we doing that because they ask us to come and they're going to reimburse us? Well, for me, it was really important to have those as two very distinctly separate line items on the P&L. One thing is kind of a sales activity, and another thing is it's not even a cost because we're getting reimbursed. So, if I didn't have that data and I just said travel, well, then what am I supposed to do with that?
Oh yeah, travel is a big one. Yeah, I mean that's where a lot early stage. Yeah, is it reimbursable billable travel that we're going to charge for? Is it sales travel going to the sales cost center? Yeah, like early stage SaaS, you see just like this big bucket of travel, and it's like okay, we've got to get a little bit more sophisticated too. So if you're a 100 millionaire, you probably have that nailed. Maybe not, I don't know. But travel, internal use software, yeah, it's gotta follow people who are actually spending it.
Yeah. So let me bring this back to the CS ROI question. Where would you set the bar, right? So like we've got a rule of thumb with CAC payback. We want to be, 12 months or less, meaning that, if we spend, $30 million on new business sales and marketing, we want to get $30 million of margin back, right? Did I mess that up? Sometimes it's hard to do the math in my head. And if we've done that, then we've got a really profitable new business engine. And if it takes us 2 years to get that money back because we spent 30 million on sales and marketing and, we only sold $20 million and we have 75% margins. So we've got $15 million. So it takes 2 years to get that 30 million back. That's not necessarily the healthiest new business motion. A, did I get that right? And then B, is that how you're looking at the same question about investments in CS?
Yeah, that's where, gosh, I wish we had a customer success payback period where just like CAC payback, it look at, all right, that investment, and then how many years does it take to pay that back? So if we are investing so much in customer success, how much is that improving retention? That's like the ARR that we're landing, and we don't expect 1 month payback unless we're PLG or self-service, maybe, but we expect that over time. So you can kind of think about that same way, exactly like the incremental 500,000. Well, maybe that only, improves retention by 250K of ARR, and now we've got a 2-year payback on that customer success. So we can kind of think about it the same way, but there are no benchmarks out there. But what I want people to think about is this gets to working capital and how capital efficient are we? Because I always say, like for CAC payback, this is like debt in our business. So I give you, Eddie, $100,000 to say get 50K of ARR, and let's just say not gross margin adjusted. That's a 2-year payback. Well, I'm now as a CFO, Eddie, I'm waiting for you in month 24. I want you to come into my office and give me that money back, right? And that's where it gets to capital efficiency. So if I have a 24-month payback, but my competitor over here has a 6-month payback and they're returning that cash back to the CFO's desk faster, I can redeploy that cash faster within my business. So I'm going to be I'll need less capital on a status quo basis with you to grow faster. And it gets same thing with customer success. So I think that's how CFOs are thinking about it. Is this then really affects the cash flow economics of our business?
Do you ever have a bar for like a rate of return or anything like that? Like I think about this, like, okay, let's say I'm the CFO of a company and we've got some free cash. I could just go buy T-bills with that, right? Guaranteed money. I don't know what T-bills are paying right now, 3, 4, 5%, whatever. And I get that money guaranteed, right? I could go lend it out and it's not guaranteed, but I'll probably get that money back. I could go invest that in the stock market and maybe get a 10% return. If I'm investing it in my business, it's an individual business. Inherently, that's riskier than like just going and investing in the S&P 500, one would think. So I'm guessing the bar is higher, but I've got this figure of 25% stuck in my head of like, well, if I can't get at least a 25% return on my money by investing it in my business, if I think that I'm going to put this money in and take all this risk and like most likely scenario, I get like a 10% return, why would I take that risk? Do you think about it this way as well?
Well, when I used to work in the airline industry, we did a lot of PV analysis on CapEx investments and different investments. So we're very disciplined there. And of course, what's that weighted average cost of capital you're using? That's, highly sensitive, just like churn, just like LTV with that churn number in the denominator. Same thing with weighted average cost of capital. But I think with software, with our businesses, it's like, if I'm not going to reinvest back in the business, why am I even doing this? Why would I go park it in a T-bill? Like but right, from a treasury function, if I have excess cash I don't need to deploy in my business, yeah, we may go park that somewhere and earn rather than sitting in our bank account. But yeah, that's the thing. It's like, all right, we could calculate WACs and cost of return and all this stuff, but why are we in business if I'm not going to reinvest and I don't think I'm going to get some return there?
Yeah, that's a great point that I overlooked. And breaking down weighted average cost of capital, if I can remember 25 years ago when I learned this in school, is basically just taking like, well, okay, we borrowed this money from the bank at this rate, and the equity that was invested into our company is expecting this kind of a return, and we average that all out depending on how much we have from each, and this is our weighted average cost of capital. Which, to your point, if we're in a mature business, especially like a public company, and our weighted average cost of capital is say 10%, then if we can't get a 10% return on investments in the growth of the business, then we should just return that money back to our investors, right? Like that's the minimum bar.
Yeah, and I think for financial sponsors, financial buyers, PE firms, they're going to be much more disciplined looking at internal rate of returns, or right, because they're putting money to work and they need a cash on cash return. So like, if I'm not going to get that, well, maybe I'm just going to sit on the money, or maybe, I should park it somewhere, because it's all about the unit economics of that dollar in, and what am I getting out in 5 years or whenever they exit on that company. So I think it's good on, if you're in that PE world, to understand those economics, where it's on their side. But as a CFO operator, I'm looking to invest, in initiatives, based on corporate priorities and objectives that will, if our goal is growth, if our goal is efficiency, whatever it is, but less so looking at cost capital. Of course, that's a consideration.
Yeah. And so bringing this back to go to market, if I'm a CRO and I'm coming to you as CFO and I'm asking for money, for example, for these 3 CSMs, essentially what we're looking at here is like, what kind of a return do I need in order to justify that? Like, are you like, given all of that risk, are you just kind of looking at this against weighted average cost of capital? Or are you saying, wow, it's really risky. Like, I want to get at least a 2x return because I assume it's probably really not going to pan out that way. Like, what's the bar I should be thinking about if I'm thinking I need to go to my CFO and ask for more money, assuming we have it? What's the bar that I need to say, I think that we could get this back in a year to justify that investment?
Yeah, I think if say someone came, a CS leader, and said, hey, I want to continue to invest in CS, it's not even going to look in a WACC or cost of capital. It'll be, all right, I'm going to look at my retention patterns. With the CS function, has our retention improved over time, gross revenue retention? And also, are we at a point where actually gross revenue retention is a good number? We're at least median performance, or maybe we're top quartile performance. Then it's a matter of, I'd say, coverage, as we scale with revenue and customer coverage, versus, we have to make a dent in gross revenue retention. So one, what's the historical pattern of gross revenue retention? Has it improved over time because we've had a CS function? If it has not improved or it's static, well, how do I know that's going to, I could just maybe not do anything and we'd continue to stay at these same levels. So I'm going to kind of look at those historical patterns. How do we perform right now? And also, for a decent size, right, you've got to segment your customer base, SMB versus enterprise, PLG customers versus SLG customers. Like, what are those retention patterns? And how does CS impact those different segments of our business? So I think it's going to actually be more big picture looking, and seeing if this makes sense, and if the overall trends and numbers justify that investment.
That's a really important point. I'm such a big fan of segmentation. I mean, I look just in our own business. We did that segmentation on this exact situation in our own business. And we just realized, like, companies of a certain size, we were just having so much trouble with. And the second that we just pulled back and said, let's just stop trying to attract those companies, all of our metrics improved drastically, including retention.
Yeah, that's a good point, right? What types of customers are we requiring? Are they the right ICP? And maybe no matter what CS we push at them, it's not going to improve, because we're just we're getting those customers from the wrong channels, or they just don't fit our ICP.
Yeah. Well, this is awesome. Like a lot of math here. Like I said before the call, like somebody's driving on the freeway trying to listen to all this and they haven't heard weighted average cost of capital or magic number before. It might be a lot to digest. But this is great. Ben, if people want to learn more, we'll put the link to the article I mentioned in the show notes. How else can people find you?
Yeah, definitely. That will take you to my blog. I've got tons of content, different concepts or topics that I cover there. Of course, a bunch of templates that you can download. And then, if questions come up, people can email me at ben@thesaascfo.com.
Awesome. Well, thanks again for joining us.
Thanks, Eddie. Appreciate it.
There's no us. It's just me.
Yeah, just joining you.
Awesome. Thanks for listening to the episode. If this resonated, please give us a 5-star rating and a follow. It helps us reach more people, and you get our latest and greatest content without having to search for it. And if you're looking for hands-on help in go-to-market strategy and/or RevOps, please reach out to us. We help our clients with everything from annual planning to improving processes in go-to-market, implementing systems to support those processes, and go-to-market AI. We're always happy to offer a free consultation to help you identify the best opportunities to improve your go-to-market engine with or without our help. You can find us at unionsquareconsulting.com, and the info will be in our show notes.